Bismillahirrahmanirrahim. Assalamu alaikum and welcome to another lecture. Today's class we are going to cover a very important lecture, that is the ratio analysis. Right? If in exam there is going to be a performance analysis question or any kind of KPIs analysis question, this topic is going to help you a lot in that kind of question or in that kind of task, right? And the key to handle these kind of scenario is very easy. That first calculate, you would be given the data of the current year, let's say current year, okay, and maybe you would be given the data of the industry, all right, or maybe your own last year, or maybe your own last year, or maybe your competitor. So what you need to do, you need to calculate the important ratios for your current year, or for the industry, or for your last year, or for your competitors, and then you have to compare it. One kind of question, this is one kind of question which can come into the exam, right? That you have to compare the ratios from your previous year performance, or maybe with the industry, or maybe with the competitor. Or the other kind of scenario is that you would be given the information of only your current year, only the current year, all right, and you would be required to actually assess the performance and reasons behind any ratio of being high or being low. For example, if the, let's say, gross profit margin is high, so you have to first find out this thing that the margin is high, and then you have to explain that what could be the possible reason that you can see from the exhibit, or maybe from the pre-scene, or maybe from your general knowledge, that what could be the possible reason, or what are the possible reasons because of that the GP margin has increased or decreased. These kind of scenarios are going to be tested from the ratio analysis question. So now that we have understood this, now let's move forward towards going through these ratios. And I'm pretty sure that none of you would say that, sir, we have never heard about these ratios. All of the ratios which we are going to cover, you have already covered it, but from the different perspective, but from the perspective that you only want to calculate them to earn the mark. But in our subject, we have to actually interpret them. We have to see that what they are telling us, what are the reasons behind the increase or decrease of these ratios. All right, so now we have different categories of the ratios, and we have bifurcated them. So we have P&L ratios, those ratios which are calculated from the profit and loss account figures. We have some ratios that are calculated from the values or the figures that are on the balance sheet, and we have some other non-financial ratios as well, which actually indicates about the performance of the company from after interpreting them. So let's start them one by one and discuss that what ratio is calculated how and what it actually interprets. All right, so in the P&L ratio, first we have the sales trend. So the sales trend is very simple. When we talk about the trend, it talks about the history. When you are in a simple word, comparing the current year sales with the previous year's sale and see that what is the change in the sales. Is it increasing or is it decreasing? If it is increasing, then what percentage of increase is? If it is decreasing, what percentage of decrease is? So the sales trend is actually about the percentage change in the sales. All right, and this comparison can be with your own last year, or maybe with the industry, maybe with the competitor. All right, so this sales analysis can be year to year. That means that your last year and this current year, maybe with the industry, or also with your budgets. If you budgeted that you will make a sales of, let's say, 1.5 billions, all right, uh, and your last year sales was 1 billion. So you targeted that the sales will increase by 0.5 billion. All right, you targeted it, you budgeted it, but actually you were able to increase the sales by 0.3 billion only, and your sales was 1.3 billion. So the change the change was 0.5 billion as budgeted and 0.3 billion as actual. So now you're going to compare the sales change or sales percentage change from your budget and from your actual. So this is again one kind of comparison which you can do. Then we have the GP margin. So the GP margin is, how it is calculated. Number one is that you calculate the GP margin by, dividing the gross profit with your revenue. Whenever you need to calculate any kind of margin, you divide it by revenue. So how you calculate the GP or the gross profit? Revenue, it's the first figure in your P&L. So we have first done the sales trend analysis. All right, sales trend analysis. And now revenue minus cost of sale, you get the GP. All right. And when you divide this GP by the revenue, you get the GP margin. So basically, what does this GP margin tell you? All right. This GP margin actually tells you the cost efficiencies and the economies of scale. It actually tells you that, for example, if your revenue was 100, all right, and you incurred the cost of sale of $60 and you had the GP of 40. So it shows that the GP margin is 40%. It is showing that your 60% of the portion from revenue goes into the cost. All right. So if you are going to compare it with anyone, you would come to know that how much cost efficient you are. If your GP margin is lower than anyone which you are comparing with, it means that they are efficient, they are cost efficient, and you are not cost efficient. All right. They are able to realize the economies of scale, reduce their cost, but you are not able to. So that is what the GP margin actually tells you. All right. So if I would ask you that what could be the reason behind the decrease in the GP margin or increase in the GP margin, always talk about the elements through which the GP margin is calculated. So the GP margin is calculated by GP and revenue. How GP is calculated? GP is calculated by revenue or cost. So these are the two reasons. Either revenue or cost will increase or they will decrease, and it will have an impact on your GP ratio. All right. Now let's move forward about the NP margin, that is the net profit margin. Similarly, like a GP margin, the net profit margin talks about that how, what are the expense ratio, like where is your revenue is going after deducting the direct cost, because in the GP this cost is the direct cost, this cost is the direct cost. And when you are selling something, the direct cost will always happen, but after direct cost there are going to be the admin related expenses, selling expenses, there are going to be finance cost, there are going to be other expenses. All right. So these are basically reduction from your gross profit to reach the net profit. All right. And also the taxes. So these are actually the leakages from your GP, that after calculating the GP, now you're going down to NP, but during that traveling, some of the revenue, some of the profit is leaking somewhere. Where it is leaking? Admin, selling, finance, other expense, taxes. And that you need to evaluate that which is the one who is actually causing the unnecessary leakages or the significant leakages, which you need to actually look upon and you need to rectify. So the net profit margin actually tells you this thing, that for example, if your GP margin was 40% and you ended up on the 10% net profit margin, that means that your net profits were $10 and you divided it by the revenue, you got the net profit margin and it is 10. That means that, you know after having that 40% GP, 30% of the profit or the 30% of the revenue further was, leaked by these elements, these costs that you need to check. All right. Then we have the ROS, we all know about it, return on capital employed. So the capital is actually the equity that you have, invested into the business. All right. And the net profit, that's the actually return that you have earned and that you will give to the equity holders. So net profit is the return to the equity holder, and when you divide the net profit to the equity, it will give you the ROS. And you know what it actually tell you? It actually tells you that, for example, if there is one shareholder, let's say that I have invested $1,000 in one company, and that company gave me the dividend of $100 at the end of the year. So I will say that I earned 100 divided by 1,000, I earned 10% of the return on the capital that I employed into the business. All right. So that is the ROS. All right. How ROS is increased or decreased? Either your equity is increasing or decreasing, either your net profit is increasing or decreasing. And I'm pretty sure that you are well aware about the mathematics expertise that if something which is in the denominator, if that thing will decrease, the ratio will increase. It's inversely proportional. And if the thing that is on the numerator, if that thing will increase, the ratio will increase, and if that thing will decrease, the ratio will decrease. All right. So it is directly proportional and it is inversely proportional, and we all know about it. And net profit, it's all the elements that are these are the all elements that will tell you about the net profit. Then we have the return of investment. So the return on investment means it includes both the equity holder and the debt holder. So when you include the equity and debt, and then you divide the net profit by the total equity plus debt, it gives you the return on the investment, because the debt holders, they have also invested. They are not the equity holder, but they are investors by means of lending. So they are also your investor. So you will divide the net profit by equity and debt, and it will give you the return on investment, and it is similarly in the same way. All right. So now let's move forward towards the balance sheet ratio. And when I talk about the balance sheet ratio, I know that there are few ratios that would directly, instantly pop up into your mind. And who they are? They are current asset ratio, quick ratio or the asset test, gearing ratio or the interest cover ratio. Yes, you are thinking right. These are the main ratios that you need to actually look for when you are doing the analysis of the performance of the company. So when I talk about the current asset ratio, it actually calculated by dividing the current asset by the current liabilities. And what it tells you about the ability of a company to meet the liabilities in the short term and the working capital requirement. Because you are talking about, sir, you are talking about the current asset, current liabilities, and we know that the current means the short term. So the current asset to current liability ratio, it tells you that if the current ratio is more than one, it tells you that the company has the enough assets to pay off its short term liabilities. Because if your current assets are less than the liabilities, so it shows that the company would not be able to pay off its short term liabilities when they will become due. All right. And the working capital as well, it's a part of current ratio. So will you be able to meet your working capital requirement? This current asset ratio shows, right? If it's more than one, it shows that yes, you would be able to. But sir, that means that if the current ratio if the current ratio is higher than the one, it's a good thing. No, I didn't say this. I'm telling you what it shows, but I am not saying that it's a good thing or it's a bad thing, because you have to see this from the business nature. Business to business is it varies, and you have to look at the your own targets. You have to look at the industry, that in industry the current ratio, what is the prevailing current ratio, what is the average current ratio which the industry is maintaining. And if your ratio is near to it, that means that you are doing good. And if you are far from it, that means that you are doing bad. All right. So that's how you are going to look at, because the numbers, they are relative, so you have to compare it with something to see if they are good or they are bad. All right. Then we have the quick ratio or the asset test. The current ratio, it includes all the current assets. But if I talk about the all current asset, there is one item, that is inventory. This inventory is not as much liquid or as much short term as the other assets, because the inventory, it is not in your hand to realize the cash from inventory. Why, sir? Because it's on the customer. When they will purchase, you will convert the inventory into sales. So it's not in your hand, but the other assets, they are more or less in your hand. So that is why, if you want to do a better analysis, remove the inventory from your current assets and do a asset test, do a quick ratio test. How it is done, sir? Remove the inventory from the current asset and divide them by the current liability. It tells you the more effective form of the current asset ratio. All right, the same thing about the current asset ratio, but more effective, because you have excluded the inventory. Because when you were saying that we have, let's say, $100 of the current asset to pay off $90 of the liability. All right. So now if I say that $5 was the inventory, $5 was the, so remove it. Now talk about the liquid asset, that how many liquid asset you have to pay off your current short-term liabilities or manage your working capital. Getting the point? Now, gearing ratio. Gearing ratio, how is it calculated? It is calculated by dividing the debt and your equity with your equity, or maybe by dividing the debt with the debt plus equity, because debt plus equity, we sometimes use that this formula, and sometimes we use this formula. Sir, in exam, what we should use? In exam, either it would be mentioned in the pre-scene that how the gearing ratio is calculated, or if it is mentioned nowhere, then not in the exhibit, not in the pre-scene, not in the question, then it is up to you. Okay, use anyone, but mention in the exam that which formula you have used to calculate the gearing ratio, and believe me, you will get full marks. All right. Then, what it actually tells you? It actually tells you about the financial stress on the company. Remember, you all have studied. I know that you all have studied that the greater amount of debt company has taken, it increases the financial stress on the company. Obviously, it's an obligation on you, it's a liability on you, and you have to pay the interest on it. So it increases the stress on the company. All right. And also, the financial risk. Financial risk is that, let me tell you this one thing. Yeah. For example, if I open one company, ABC company, all right, and this ABC company, I inject 10% of my equity and 90% of debt. 90% of debt. What do you think? The financial risk is high or low? Financial risk is high or low? The chances of me doing the default is high or low? Why? Because sir, I have only 10% of equity. Even if I will go to the bank, even if I will go to the bank and say that I need more fund to expand my business, the bank will say you only have 10% of equity and you are asking for more. And if what if something goes wrong? Because it's a debt holder's money, it's not your money. So when you increase the debt amount, the financial risk actually increases. The debt holders risk increases, because these debt holders, they will also be concerned that why the hell this person is not injecting his own money into the business. Is it risky business? Is it unsuccessful business? Is it a doubtful business? Why? The financial risk increases. Then we have the financial difficulties or expansion in expansion. Why? Because if you will go to the lender and say that I need more debt, they will say you are already having so much debt, and first try to pay them off and show us some feasibility that how you're going to pay them, how you're going to manage it, right? So that's how you will face more challenges if your gearing is too high. All right, if you have too high gearing, you will face one, two, and three, these three issues. But sir, what is the gearing ratio which we will say high? 50%? More than 50% would be high, or less than 50% would be low? No. Again, you have to see that in your industry, what is the average gearing ratio? If the gearing ratio is near to the industry, that means that you are okay. If it is less than, it shows that you have the capacity to borrow more. And if it is more than the average, it shows that you are already too much geared and you have too much debt as compared to the average of the industry. Right? Then we have the interest cover ratio. Now let me read it again for you. Read it with me. Interest cover ratio. I took a break. Why? Because I'm talking about something that is going to cover the interest, right? And that's the ratio. That here we are going to divide the net profit by the interest cost. So why? We need to check that how much capacity and how much ability our net profit have to cover the interest cost. What's a we didn't get it. Let me explain. For example, my net profit was $200. $200, and my interest cost is $25. All right. So now, if I ask you that, this net profit, how many times this net profit can cover this interest cost? So you will divide this 200 by 25, and you will say that 8 times my net profit has this much ability and capability that I can cover interest cost 8 times by my net profit. And why you use it? You use it to show to your lenders that give us more debt, and our net profit, our operation, our business has this much in strength. We can cover the interest. How many times? You need 1 time, 2 times, 3 times? Tell us how many times we can cover it. 8 times, 10 times, 5 times. So that shows you, right? So it is the ability to pay the interest out of the profit, and it is the times of interest cost could be paid out of the profits. All right. So now if we are clear with the balance sheet ratio, now let's move towards the other non-financial ratios, all right? And these are some examples. These are not the exhaustive list, all right, or the complete list. And no one can make it. In your exam, in either in the pre-scene or in the exhibit, you will be given the ratios which the company uses to evaluate its performance, all right? So now if I talk about them, first we have the employee per revenue. Revenue per employee, it shows the efficiency, it shows the efficiency of the employees. For example, if your employee, one employee is able to earn you $1 lakh, so you will say that my employees are too good. One employee is earning me $1 lakh, right? So it shows that how much efficient your employees are in the industry where the customer dealing is with one-to-one employees, and you can dedicate the customer to one employee, and then you can see that how efficient they are. Then revenue per square feet, it shows that, for example, if you are a business who is having a mall, restaurant, or retail outlet, or any kind of shop, and then you compare that on each square feet, how much revenue you are able to generate. You are talking about the utilization of your space, of your area, that how much area you are using and how much revenue you are generating. So you divide your revenue by the square feet of area, and then you will come to know that at each square feet how much revenue you are earning. Then staff turnover ratio, again it shows that how pissed off, how dissatisfied your staffs are, how demotivated they are. So if the turnover ratio is too high, it means that you are doing something wrong, yeah, right? You are not focusing on their motivation. And even if you are doing some training programs, staff development, that would be of no use, because you would do the efforts on them, you will do investment on them, then they will go, they will leave you because your staff turnover is too high. So that shows that this is the issue in your staff retention. So you need to consider this thing. Then the carbon emission rate. So the carbon emission rate, it shows you that, for example, in some industry or in some environment or jurisdiction where there are very strict laws related to the environmental footprints or the environmental concern. So here you are going to evaluate that how much your carbon emission rate is, and whether or not you are able to control it, decrease it, or maybe you are carbon neutral, or these kind of activities, right? So these are some non-financial ratios, again the ratios, right? And which actually tell you about the performance of the company when you compare it with anything. All right. So I hope that I was able to explain you this very important topic in detail, along with how it could be tested in the exam. So see you all in the next lecture. Till then, take care of yourself. Allah Hafiz.